Hi, I'm Jacob Watts, a certified financial planner professional with Legacy Financial Strategies. Today I'm going to cover a tax-efficient investment strategy that can add real value to your financial plan. It's known as tax loss harvesting. Tax loss harvesting is the process of selling an investment that has decreased in value to intentionally capture that loss. Why would you want to do that? Because from a tax standpoint, those realized losses can be used to offset capital gains in other parts of your portfolio. And if your losses exceed your gains, up to $3,000 can be applied against ordinary income each year, with any remaining losses carried forward into future years. In other words, it's about turning a short-term setback into a long-term tax benefit. Now you might be thinking, why would I sell something at a loss? Shouldn't I hold on to it until it comes back? I can appreciate that sentiment, and it's correct to hesitate to lock in a loss. But a good tax loss harvesting trade should help to alleviate that concern. Because ideally, you're taking the proceeds from the sale of one security to immediately reinvest into something similar. Selling one stock mutual fund or ETF and buying another is a good way to ensure dramatic market moves don't leave you missing a recovery. The same strategy can be used with individual stocks, bond funds, or any other security, but you'll need to be mindful of the timing risk. Tax loss harvesting can be especially useful in years when you've sold stocks, funds, or real estate at a gain. You're expecting a higher than normal taxable income, or markets are volatile and some holdings are temporarily down. For example, imagine you sold an investment for a $10,000 gain. By harvesting a $10,000 loss elsewhere in your portfolio, you can effectively erase the tax liability on that gain. If you don't have any gains to offset, you can still use up to $3,000 of losses against your ordinary income this year and carry the rest into future tax years. There are rules to watch closely. The most important is the wash sale rule, which says you cannot claim a tax loss if you buy back the same or substantially identical security within 30 days either before or after the sale. You also cannot sell a mutual fund to buy another that invests in substantially identical securities. As an example, would be selling a Vanguard S&P 500 fund and buying a Fidelity fund in the same index. This means you need to be strategic about what you reinvest in and when or if you choose to buy back the position that you've sold. The goal is usually to stay invested while taking advantage of a tax loss from another trade. Tax loss harvesting can be a valuable tool to lower your tax bill and make your portfolio more tax efficient, especially in volatile markets. But because the rules are complex, it's best coordinated with both your financial advisor and your CPA. At Legacy, our team helps to ensure strategies like this are applied thoughtfully and in alignment with your bigger picture. I'm Jacob Watts. Thanks for joining me, and we'll see you next time.